Morning. Welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting live from Chicago. And today is Monday. It is November 24th. It's Thanksgiving week. It's 2025. Good morning, TheoTrade numbers. We've got a big crowd today. I'd like to get us over 1,000. We're up over 900. Let's get to 1,000. It's the goal. Good morning, John Fleck. Who's the new people? We've got some new fish here. Rodney G, Rogue Bro. Hey, Tim, Trains, Ship, Florida Woody, Bart F, Michael Gill. Last Friday was a monster day for the Genesis Cog. Today, it's just they're rocking the boat back to the other side. They're like, risk off Friday, risk on Monday. They're just moving money backwards and forwards and chopping until we finally give out. That's what's happening, people. I will dig into it. I promise we'll talk about it for the next 30 minutes, and then we'll jump into today's topical discussion. As I say every time I come in here, no disrespect to all of you, because I do appreciate you. If you want to ever go one-on-one with me, you can. You probably have to join the Genesis Cog Mastermind class, which is being offered in January. We are not sold out yet, but we've already signed up 8, and we are maxed out at 20. Get in and get in early. Take advantage of the sale this week, which I'll bring up at the end of the day. In the meantime, we're going to go into motivations behind channeling. Today, when we get past the half past hour, I want to dive into today. And this is a day where a lot of you are going to get fooled. This is the biggest load of garbage crap they ever. It's just one big garbage lie. Okay, the news media is going to pull something out and say it's going up because shut up. It's going up because it's rigged. It's 99% of the time it goes up on Thanksgiving week. Your point? There are no fundamentals today. It's just call buying, jamming higher, low vol, gamma squeezing. Here we are. With that said, today's theme comes courtesy of the myth of Sisyphus. How many of you out there, of all the TheoTrade members, how many of you are comfortable or have been familiarized with the myth of Sisyphus? Come on now, cough it up, you Greek philosophy majors trying to hide. Let me get you to it. So there's a figure in Greek mythology, and I'm going somewhere with this, so bear with me. I always tie things together. It's what I do best. So Sisyphus is a figure from Greek mythology known as the cunning king of Corinth, who was punished by the gods for his deceitfulness. His punishment involved rolling a huge boulder up a hill, only for it to roll back down each time he reached the top, symbolizing the endless struggle of human existence. So the philosopher Albert Camus piggybacked off this. He interpreted Sisyphus's plight. He wrote an essay called The Myth of Sisyphus, suggesting that the struggle itself is enough to fill a man's heart, concluding that one must imagine Sisyphus happy. But this reflects the absurdity of life and the human condition, where the pursuit of meaning is often met with futility. Let me dig in a little further into this, if I may. A little bit more detail. So in Greek mythology, Sisyphus, spelled Sisyphus or Sisyphos, Sisyphos, is the founder of the king of Ephyra, known as Corinth in books, in textbooks, Corinth. He reveals Zeus's abduction of Aegina to the river god Asopus, thereby incurring Zeus's wrath. His subsequent cheating of death earns him eternal punishment in the underworld once he dies of old age. So the gods forced Sisyphus to roll this immense boulder. Look at your screen. This immense boulder up a hill only for it to roll back down every time it neared the top, repeating this action for eternity. Through classical influence on contemporary culture, tasks that are laborious and futile are therefore described as Sisyphean. So, does it any wonder, TheoTrade members, where the hell am I going with this? Why the hell are any of you buying this crap? It's Sisyphean. This is the myth of Sisyphus, the market. Every day I wake up, it's the same old crap. We're up 9 out of every 10 days. The market's not balanced. It's not evenly spread. It's not random. It's rigged. And they're rolling it up again because they can, because it's the end of the year, because it's the end of the quarter, because it's Thanksgiving. So this is what I see inside my model. We're going to roll up the hill, and then we're going to roll back down the hill. This is exactly how markets work. They bait you in. When they're ready to be bullish, they roll it down the hill, get you out, you short, and then they roll it back up and break new highs. That's how it works. This is the opposite. It's like Alice in the Looking Glass. You're in a Sisyphus market. You have no reason to buy, none. The Fed may or may not cut rates. The economy's getting worse. Inflation's totally out of control. The job market is a crap fest. They lied on Friday and the market knew about it. That's why it sold off. It's ran up and ran back down because the market knew those were phony numbers. People were in a position where the economy's compressing. We're in a slowdown. Dare I say we move toward a recession, stagflation. This is the direction we're going. Irrespective of AI, it doesn't do anything. Okay, things are getting worse. They're not getting better. In politics in this country, so much strife back and forth. We don't discuss that here. This is what I call the Sisyphus move, where everybody starts bidding, they start buying calls, they parabolize. I have a simple rule of thumb, and it's fared me for pretty much most of my life, and it's worked really well. Never short into an uptrend and never buy into a downtrend. If you follow those two rules, I guarantee you'll survive forever. But if you keep chasing this stuff when they pull it back or shorting it, they're going to wipe you. This is likely to go up to the top edge, likely to go up to a 70 on the RSI. We could be up 130 or 40. I just don't care. It's such garbage. There's no fundamentals behind this, people. It's just the end of the year. They're just moving it up and trying to bring it up before they like hit some number and then they roll it down. So it wouldn't surprise me today to see the market stay up here and then roll down back at the end of the day. You're in a Sisyphusian market. Don't be fooled by this. The most important indicator is the weekly MACD. It's never wrong. And what I'm telling you is the momentum on the market is already broken. People, it's already broken. It's already broken. But the trend is not broken. So the dip buyers are going to continue to try to push this up and push this up. But eventually what you're going to find out is this is the end game right here. Just like over here in 2025, we're going to blow through. It's inevitable. So they'll push this up through December, as I said they would. And then once we get there and the MACD pivots to the downside, gains traction, gains what I call down in distance, the histogram bars start growing, and we start heading down, you're not getting out. You're never getting out. We're just going to go straight the hell down. So I've written this off. I just like, we'll bounce off of 6,500. But once we go through, it'll start that corrective moving process. Nobody wants to sell now because it's the end of the quarter. It's the end of the year. It's another up year. It's another way of sucking money out of your clients and blowing smoke and basically gaslighting them and telling them this is the way it's always going to be, which is garbage. Again, don't be fooled. Think of the myth of Sisyphus. You're rolling the ball up the hill only to roll it down. This has happened over and over for the last 2 weeks. Don't expect anything. They just rolled into tech today, and that was it. That was the only thing. They rolled into tech. Whatever was up on Friday massively was sold today because I own those. I had a monster day on Friday. They've given back half of that. They took that money. They rolled it back. People, stop overthinking this. Turn off the CNBC nonsense. Just turn it off. It's just rotations. Their money moving back and forth. The boat tips this way. It tips back, going back and forward. That's all it is, people. So that 76 points is all technology because financials are not falling through today. How do I know? Because I'm short a couple of banks are getting slammed today. That's how I know. It's just tech and nothing else. It's moving the markup. Don't bite on this. All right. So when it comes to macro movers, catalysts, this I think is interesting for a lot of you to understand. I haven't heard this argument ever, so I'm going to give it airplay. I'm going to give it exposure. Okay. So bear with me as I plug, okay, Garrett Baldwin. Garrett's thesis, and I think it's pretty cogent, I think it's very sound, is simply the market is based simply upon liquidity. And if you keep pumping liquidity in the market, you jam it higher. It's literally like a cocaine addict where you're just constantly sticking a needle in him or you're snorting on the desk and you just never let that cocaine addict come down. It's like this perpetual high. But when you run out of the drug, which is liquidity, markets implode and crash. So the idea here is I call it tip, top, tap. Now, bear with me on this one because you have to be from Chicago to understand this. At the top of the Drake Hotel by the water, it says right at the top in letters, tip, top, tap. Okay, that's a Chicago thing. Not sure what it means, but for me, it means that we're at the tip top of a market cycle. So what a veteran strategist came out today, and he was in every magazine. I saw it in Barron's, I saw it in Market Watch, I saw it in social media, I saw it in Bloomberg. It was everywhere, and I found it interesting enough to give him airplay. The stock market has peaked, according to a veteran market manager named Michael Howell. Michael Howell runs billions of dollars for cross-border capital. Cross-border capital. He is a strategist there. I'm not sure he's the CIO, but he said right now we're beginning a 3-year downturn. It's already started, a 3-year downturn, and the market has peaked. What is his defending thesis on why we've peaked? And I'm biting into it, and I'm starting to like the sandwich. He believes that the speculative phase of the US market has peaked, and there will be a downturn for stocks that could last 2 to 3 years. That wouldn't surprise me. We're massively overbought. Garrett, we're down for a week and you think we're oversold. Garrett, if we went to 4,000, we'd still be overbought. So just hold off on this. Howell suggests that gold and commodities are the best ways to protect one's portfolio during this time. Howell predicts gold might go as high as 10,000 an ounce. I'm not biting on that. Sorry. By the mid-2030s. Howell's theory of the global liquidity cycle, which he believes dictates markets' behavior, it's consistent with Garrett Baldwin, okay, suggests that global liquidity runs in cycles of roughly 5 years, with the last one starting around the time of the global pandemic in 2020. This cycle is expected to last about 4 to 5 years, maybe 5.5 years. And the withdrawal of liquidity is already causing some tensions in the repo market. Garrett mentioned that. Howell's research indicates that there is $350 trillion of debt globally. $350 trillion, and roughly $70 trillion needs refinancing annually. This withdrawal of liquidity is already causing some tensions in the repo market that have been witnessed since 2019, persuading him that stocks are not on the right side of asset allocation at this juncture. I'm not willing to bite into 100% of it, but I do believe, I don't know if it's 3 years, but I do believe we're at the top of a liquidity cycle, we're at the top of a valuation cycle, and we're at the top of a technical cycle and a statistical cycle. So this guy's on to something. I'm not breaking from my thesis. I don't care if the market's up 190 today. I couldn't give a crap. We're still going lower. We're just the Sisyphus. We're just pushing that ball up the hill like we do every other week, and then we roll down. This is not healthy for the market. This type of action is extremely unhealthy. Low vol, no reason, no fun, no catalyst, low vol, run by gamma squeezing my options on a week of thin trading around Thanksgiving. This is not something, don't mess with this. If I were you, I'd be very circumspect. We could give all of this back by the end of the day. I don't think we will, but who cares what I think? And give it. If we gave it all back at the end of the day, I would say, yeah, that's about right. Try to lower your equity exposure as we go higher and increase your short exposure. That's what I'm doing. It's working beautifully. Imperfect timing. Another reason why I believe we're at a market top. It was announced yesterday that there is a hedge fund. Bitcoin funds are being launched in Europe that are 3 times. They're inverse ETFs. They're leverage funds. 3 times levered Bitcoin funds are launching next week in Europe. Correct me if I'm wrong, TheoTrade members. Isn't that kind of like 2 years too late? The fact that they're releasing Bitcoin funds 3 times leverage now, what worse time could you ever release a 3 times leverage fund now when Bitcoin is unraveling? Because to me, Bitcoin's just a scam. And yet Tom Lee says Bitcoin's going to 200,000 by the end of January. Good luck with that one, Tommy. Tommy boy, good luck with that one. Listen, try to value Bitcoin. Tell me how to value it. Prove to me you can value it other than supply and demand and technicals and emotions. Go ahead, do it. Because if you can't, I'm not interested. This tells me that we're not even close to a bottom. If they were to say, hey, these Bitcoin funds are being repealed, we're closing it down, we're not going to launch them, then I would start to think that there's sanity returned to the market and we're closer to a bottom than a top. This tells me we're so close to a top, it's not even funny. And the last but not least, I call Truth or Consequences. If you ever go back, because when I was a kid, there was a show called Truth or Consequences. I'm not sure if it was Alan Ludden who ran it. I'm not really sure about that, Betty White's husband. But the idea here is this. Fed Chairman Powell said the 6 most dangerous words in the English language for a Fed governor. He said, equity prices are fairly highly valued. Notice what he said. Listen to his choice of words. He doesn't say equity prices are highly valued, because if he says that, the market crashes. The guy couches his terms with a lie. He spins a lie and says, well, they're fairly valued, but I'll just throw in the word highly. So they're fairly highly valued. Okay. Jerome Powell is sending a message to the market to sell. He wants all of us to sell, which he should be. Why is he doing that? So he can cut rates. If equities value prices stay up here, he has no reason to cut rates. Cutting rates for the job market ain't enough. The job market basically has nothing to do with it. You cut interest rates for one reason, because inflation's come in and you want to stimulate the economy. Inflation's not coming in now, next week, or next year, people. It's not. It's going up, and gold's going up. That's inflationary. So Powell is trying to say indirectly, in a very innocuous, tacit way, he's saying, listen, please sell the market so I can cut rates. The market ain't going down, and that's putting him between a rock and a hard place right now, because the market doesn't go down. He might be strapped. He might be hard pressed not to cut rates, because the governors, the 12 of them, are split 6-6. 6 say cut, 6 say don't cut. So he's the deciding vote. And if he's the deciding vote and they don't cut, this market's in for a crap fest of selling, because the market's just hanging on one thing. The liquidity cocaine dealer himself. That's right. He's the cocaine man, Jerome Powell. Just keep popping those liquidity in the market and keep driving up. You just keep feeding it the drug, people, the money drug. This is a bad time to be investing in the market. If you're going to invest, you should invest in defensive stocks. You should invest in dividend stocks. You should be doing what we're doing, which is working beautifully. We own defensive stocks. We've had Monster Day on Fridays. We have dividend stocks that are shielding us. This is the type of market where when it ends in December and January, I think this market is like just going to get a rude sell-off, just because nobody needs to own anything and there's no more catalyst to go it up other than window dressing and Jerome Powell. So again, think of the myth of Sisyphus. They're pushing the ball up the hill today. By the end of this week, if we're down underneath 6,600, I'm just going to say I told you so, because they're just rolling it back up and down. They're trying to elevate it, to levitate it, so that their money managers can get their $5 million bonuses. That's all they do right now, because they got nothing, no reason to buy. Nothing's really that cheap except consumer staples. That's the only real cheap thing. And some retail stocks are very cheap. Gap's pretty cheap. Lululemon's pretty cheap. Other than that, there's not that many cheap stocks out there. As far as individual rotations are concerned, Babalu IA, AI, I should say. It's like I'm copying Ricky Ricardo. So here's the deal. BABA's your stock of the day. It's up $7. Okay, couple of things to mention about BABA. I don't trade BABA because I don't trust their fundamentals. I can't read. This is the biggest scam ever. I'm going to treat all this. You can't read it. It's all garbage. It's not gap compliant, so it's all a waste. It's all a lie. Don't even trust one part about it. You're trading basically off the technicals and nothing else, and narrative, and maybe CNBC, which I wish you wouldn't do. I'm not going to short it. I'm not going to buy it. It's too close to earnings. But you all need to know what's going on. If you don't know what's going on, you better wake up around BABA. Alibaba Holdings, okay, has a new app coming out. The app is called Qwen, Qwen. What is it? More than 10 million downloads in the week after its relaunch hit. They launched it last week. 10 million downloads. It's boding well for the longer term effort to build a rival to OpenAI's ChatGPT. OpenAI's in a big mess of trouble, Donnie K. Big mess. Because BABA has, quote unquote, what they advertise as a better AI product, better than ChatGPT, and it's launched by BABA. Now, if that's the case and people gravitate, remember, OpenAI owes a lot of money to a lot of people. They're borrowing, and they need that IPO to survive. So this call is not as much about BABA as it is about OpenAI. OpenAI, to me, is in a lot of trouble if BABA starts taking their market share. People like, well, OpenAI, BABA's got a better product, and they move over there. What's that say for OpenAI? Okay, be aware of this. This is a stock. This is not me telling you to short OpenAI. It's telling you, like, if you wanted to buy BABA just off a narrative, not fundamentals, this is probably a good entry point. My only problem with this is I never buy in front of earnings, and BABA reports earnings on the 25th, which which is what? Which is effectively coming out tomorrow. So after tomorrow's close, BABA reports. I won't buy it, but this is a trade. If I were you, and if you think there's going to be volatility sparks, hell, go in and buy that straddle. It's a $9 move on the stock. Just make sure you don't pay more than 10 bucks on the straddle. Don't pick a direction. Just play the vol trade because BABA reports tomorrow. This is a BABA trade, and they're gaining traction simply on competing with OpenAI. I think this bodes really, really, really badly for OpenAI to know that there are more players out there taking market share. So if you own OpenAI, I'd be a little bit circumspect. Next on the list is that, and I reported this last week, I call it the AI hedge poster child. Now, I know for a fact the stock is probably up today. I saw it up in pre-market a couple of bucks. It's up 244. Wouldn't touch this stock with your money. I have no interest whatsoever. Number one is I never trade ahead of earnings, and earnings are too close for this. Number two, the stock is in a downward algorithmic slope, and the Genesis Cog rules dictate we never buy in a downward slope. That's why we don't get burned. That's why none of the accounts crater. That's proof positive. We don't crater because we don't buy this stuff. We wait till it bottoms out, sideways channel, rebuilds, and brings back in liquidity. This is a bad, bad situation. But here's the deal. There is a massive surge in credit default swaps for Oracle. The market, it's a crucial hedge against an AI crash. It reflects a deep skepticism about the financial sustainability and the stability of the rapidly expanding artificial intelligence sector. This development is being widely interpreted across financial markets as a strategic maneuver to protect against broader market volatility and credit deterioration that could arise if the AI sector's aggressive growth trajectory encounters significant headwinds. The reason why I'm bringing this up is not because of Oracle as a trade. What you need to do is you need to go to every single AI stock and you need to dig into their investor relations and news and find out if there are credit default swaps being purchased on that stock. Because if they are, that stock's going to get taken to the woodshed. This is the poster child. Everybody's now going and now investigating AI swaps on NVIDIA, AI swaps on AppLovin, AI swaps on Palantir. All these stocks are at risk of crashing, every one of them. Because if the credit default swap narrative starts to walk itself into existence and people are betting as if it's a 2008 like CDS housing market bubble, this could undo and completely unhinge the AI trade and take the market down. So the poster child is Oracle. What you need to do is watch Oracle as a benchmark. It's a vanguard. If Oracle continues its weakness, that is going to continue to put pressure on the AI trade. I'm telling you this right now. So if you own AI stocks, don't live in a bubble. The valuation metric is not going to help you. What's going to help you is tracking Oracle and finding out how much leverage there is in a CDS trade to that underlying. That will help you position yourself around AI stocks that could be meeting their day of reckoning. I kid you not. I don't own any. I don't want to. I'm a valuation guy, so I'm not interested. Okay. Third, short interest. I'm going to pose the question to all of the TheoTrade members out there. How many of you know out there which particular stock in the S&P 500 has the largest short interest? Do any of you know? I didn't say not by shares, but by percentage of the underlying float. Number one is Moderna. Moderna is the number one shorted stock by mRNA, pardon me. It's number one on the short interest as a percentage of the entire flow. So what I'm telling you is I'm telling you this. I'm not telling you to buy that. I'm telling you, if you're shorting that, get the hell out of that stock and send me a love letter. Go ahead and send me a box of chocolates. Do not be short this. When I hear stuff like this, all you need is one day where they circle the wagons and they do what's called like the ultra gamma squeeze, the meme trade. They're like, oh, here we go again. And they get it on the social media boards to Barstool Dave. You are beeped. You're screwed. They'll wreck you. Don't get short that stock. No matter what you think, don't get short that stock. When I hear stuff like that, I'm like, if I hear any stock has a high short interest and I'm short, I want out, because you're not getting out if they have all these meatloaf mommies in the basement who live with their parents, like, the Seattle mayor, okay, lives with her parents. If they start buying calls in that, you're done, because it'll take days and days and days to cover that. That's like a really like dangerous thing to hear. It shocked me. I was thinking it'd be something like Palantir. I was thinking it'd be something like Google. It's not. The most shorted stock in the entire S&P is Moderna. Be careful. They're also a one-trick pony. Their drug, because of, there is no serious COVID, the stock became like a one-trick pony. They beat it down. It's in a algorithmic channel. I wouldn't buy it because they just keep bleeding money. But I still wouldn't want to be short, because if they are bought out, that could still blow your account out. Last but not least, on my stories of the day before I move forward, okay, luxury escape. This is a commentary on a stock that none of you track, including me, VWAPY. So every one of you, put in your search engine or in the symbol up here, VWAPY. VWAPY. Volkswagen. As in Volkswagen, it's an ADR, it's an American Depository Receipt. This is Volkswagen stock. The Volkswagen Jetta, the Volkswagen that got, investigated because they were cooking their books and threw out the CEO. Remember that? And they had all kinds of problems with their catalytic converter, that Volkswagen. How many of you at TheoTrade know that Volkswagen owns Bentley? Huh? Anybody out there? Any of you out there know that Volkswagen actually owns Bentley, as in, not Rolls-Royce, but the Bentley? What you may not know is this. Volkswagen came out this particular weekend and they had a investor meeting. And guess what the CEO said? He said, quote, "We are really bullish on our new Bentley Continental." Have you seen the Bentley Continental car? I'll bring one up for you. Bentley Continental GT. Anybody ever see the Bentley Continental GT car? Here, I'll bring one out for you. It looks just like this. Here, let me bring like a decent picture for you. All right. Hold on. Am I being able to open this one? I guess I'm not. They're not allowing me to open that one. Let's try this one. See if I can open this one. Can't open that one. I'll have to bring it to you. There's the Bentley GT. It's like a $275,000, $300,000 like luxury sports car. Well, guess what? The CEO said, and this is important. It's like I call it the canary in the coal mine. He's saying, we see the luxury market declining next year. Now, understand where I'm coming from. The American consumer who's at the middle class and below is just choking on debt, dying of 1,000 deaths every day. I was out at recently at Fulton Market. It's a few blocks from where I live. It was completely empty on Friday night. Usually on a Friday night, it's popping. It looks like Times Square. There's 1 billion people. It was completely, literally empty. And it was a beautiful weather night of 55 degrees. So the regular consumer is in trouble. Here's the thing. When the wealthy, remember F. Scott Fitzgerald, the rich, they ain't like you and me. When the wealthy are worried about the state of the economy and not buying luxury cars, that's when you know the economy's at top. Because the wealthy don't care. The economy crashes, who cares? They have so much money that the wealthy are worried about the economy. Not the little guy, not the person making $60,000 a year. The people making hundreds of millions a year are cutting back their spending on luxury cars. That's not good for nobody. That caught my attention. So I'm just throwing it out there that if the upper class, the middle class, and the lower class are worried about the future, that's not good for the market. And the market's going up because Wall Street just says, okay, we don't care. Of course you don't care. All you care is to get you to the end of the year to play beat the clock so you can get your bonus. All this is probably going to go away in January, just like it does every year. If we were to crash 1,000 today, I'd say buy. But at this point, I'm telling you, this is just another Sisyphus move by Wall Street. They're just not listening. The CEO at Volkswagen has told you the economy is not doing well across Europe. The wealthy are cutting back their spending. That's a big deal to me. All right. Now we're going to go straight to today's discussion. And today's discussion is Part 3 of motivations behind sideways price channeling, part 3. The subject line matter, I just call it killing time. Okay, killing. Boy, my shorts are really doing really well today. It's my longs are not doing well. That's because they're selling off the defensive ones. Pardon me. So here's the issue. Okay, I talked about on Friday the pause to digest and valuation equilibrium. Valuation equilibrium simply means that the money manager at the margin, at the last penny, won't pay any more for it. It's peaked in value or it's troughed in value. It's bottomed out. So they run out of sellers. It's probably a good time to buy. And they've run out of buyers. It's probably a good time to sell your position or consider getting short. That's what valuation equilibrium means as far as relates to channeling. Pause to digest means it's made a hell of a move up or down, and the market needs to just sit there and digest and stare at it for a while and catch their breath. That's normal. Today, we're going to talk about rebalancing and dearth or scarcity of order flow. So let me bring to you exactly what I mean by the motivation behind this. Let me take away all these technicals because they're not really essential. What really matters is just looking up at the chart and understanding, okay, that don't put an entire premium on the candles. Candles are important, no doubt about it. Trends are important. Fundamentals are important, okay? But don't just look at a chart, divorce yourself and go grunt and go trade short long. Step into the mind of an institutional portfolio manager and try to understand their motivations as to why they would buy it or why they would short it or just unload it at certain times. Because if you do, what you'll do is you'll exercise patience. And by exercising patience, you will learn to get your timing down better, where you have less slippage, you don't waste as much theta decay, and you'll exploit the move rather than chase it. Don't look at channels and go, look away, I'm hideous. I make a living off of channels. I make so much money off of channels, you can't believe it. You have to wait and wait and wait. Ask any TheoTrade Genesis Cog member. The most important skill is not how smart you are. It's your iron constitution of patience. Patience is the best skill ever. You will learn this one way or another. I make more money doing nothing and just sitting there than doing something because I'm trying to understand what are motivations, why they're doing certain things. So when I look at Apple, Apple's made a hell of a move, and yet it still sits here at an all-time high. Okay, what gives? Okay, why isn't it rallying even higher? Let me explain to you the position of a portfolio manager, if I may. So I'm going to walk you through this. I'm going to give you a few formations. There's a channel. There's a channel. You see the channels. I'll like activate and edit this one. I'll get a little more up here. Come on, let me drag it a little bit higher. Come on. Oh, it's not working. There you go. Channel, channel, channel. And you can see right before they make that channel move, if you look carefully on Apple, you see these flag formations. A rip, flag, rip, flag. Okay. It's a stair step or an escalator higher. It's exactly what it is. It's manipulated, it's manicured, it's curated by algorithms. It's all rigged. People, you're not that smart, neither am I. It's all machines doing this. They're just like, oh, look, flag, flag, flag. It's just over and over and over the same thing. That's what it is. Just take a look for yourself. You can see that it's an obvious pattern. So fundamentals don't really matter in the stock at this point. They don't. They only matter on the way down. I told you, if Apple fell 100 points, then the market would implode. But when Apple goes up, nobody goes, what's it worth? They don't care. I got to get on board. It's a psychology. So here's the deal with Apple. Ask yourself, why does it keep going into channels and stopping? The answer is called rebalancing. People are like, what? What is that? What the hell does that even mean? Okay, rebalancing. This is what rebalancing means, people. Rebalancing means that most, but not all, most hedge funds, almost every mutual fund, all funds from Goldman, asset managers, broker dealers, they have bylaws. They have what's called IPS, investment policy, okay, standard constraints, okay, investment policy constraints. They simply cannot have a weighting above a certain level, or they cannot have a weighting below a certain level. It is not permissible. They can't. So for Apple, when money managers buy this and they chase it, when it gets to a certain point where they say, listen, we max out, we can't have more than a 5% position on Apple, and it gets to 7%. By de facto, by default, they have to sell it. And you're like, managers are buying it. Stop. You don't know what you're talking about. They're not buying it. Okay? They're selling it. They have to sell it. They have to maintain that weighting. Their bylaws, their constraints in their IPS, investment policy statement, specifically state, it is law, it is legalese. We cannot have a weighting in a position in technology above a certain level. So if Apple is at 1.4% and it becomes 7%, the managers have to start selling. It's an auto sell. So don't sit there and tell me Apple's topped. Stop. It hasn't topped. They're just rebalancing. They're selling the Apple, generating cash, lowering the weighting, and taking that cash and buying something else. That's all they're doing. This is a normal rebalancing exercise. This is what it looks from a textbook perspective. It's a flagpole, sideways flag. Flagpole, because every time Apple moves 10 to 15 points, managers are like, damn, we can't be above 6.5%. Got to scale down. And they just start selling and selling and selling. It doesn't mean the stock's going to crash. It has nothing to do with anything other than profit taking, because they're forced to do this, people. And it cuts in both directions. Sometimes stocks get blasted and managers are like, we have a 2% weighting and we had a 5% weighting. So by default, by de facto, they actually have to go in and start buying it, because the weighting dictated in the IPS, the investment policy statement, says the lowest weighting we will keep is at this level. So they buy to lift the weighting. That's what they do. So they're constantly in mode. Don calls it like being a person who's holding balls in the air like a juggler, and they're juggling. Got to get rid of that, got to buy that. They're just moving money around like they're doing today. This is a lot of rebalancing today. They're selling off the big moves in some of the consumer staples, going back to technology. It's money moving back and forth. That's what rebalancing means. So whenever you see a huge move, okay, in a stock, stop and go, damn, that stock's up 25%. Get the get the F out of that stock now, because money managers have to sell. They don't want to, they have to sell it. They can't have a 10% weighting on Apple Oven. It's not allowed. They have to sell it. So get out before they start selling. Don't sit on there and wait, because by the time it drops 10 or 15, $30, you're like, something's wrong with Apple Oven. Nothing's wrong with Apple Oven. Money managers had to sell it, and you're the sucker who sat there with the thumb up your butt thinking it was going to keep going up. Always be aware of when stocks make certain moves. For Apple, it's usually a 25-point move, and they got to start selling. It depends on the underlying and the percentage gain or loss that dictates how these rebalances are done. Apple is like an easy way of identifying like what's going on here. Like that's one of them. Let me bring another one to you in a certain like way of looking at things, because certain stocks have to be owned. They just cannot be sold at all. So I'm going through the list here and I'm looking for like, a rebalancing one, and I'll have another one for you. Medtronic. So Medtronic made a really distinct move, and now all of a sudden Medtronic is like stuck in some type of like mode here. Look, it's in a sort of a locked mode. It was in a locked mode here. Okay. See, it just stays in a locked mode. There's nothing fundamentally wrong with it. Yeah, the PE is expanded. They need to probably take a little bit off here. But what I'm trying to tell you is that sometimes when it gets here, sometimes it's valuation prohibitive. But other times when you see a stock just hitting its head and just cannot get above and beyond that, part of its valuation equilibrium. It's hit its valuation peak. It can't move any higher. No manager will pay 1 penny more at the margin to drive it higher because it's too expensive. So they'll just start selling. In this case, Medtronic, okay, it's expensive, but it's not a bubble. But put that aside. if this stock can't move any more up here, you have to understand what managers have done. Some came down and bought it way down here at 80 bucks. And now it's up to 102. So that's a 20-point move. 20 divided by 80 means it moved up 25%. But some managers look at this and say, well, down here, we had a 4% weighting. Well, if it moves up 25%, now we got a 5% weighting. So what do they got to do by default? They got to sell it. They got to sell it back to a 4% weighting. They don't have a choice, because if they don't do it, it's a violation of a fiduciary obligation and they could be sued. And if they're monitored by, other people who are in the know in 13D filings, they can get into massive trouble. So just be aware of when you're in a situation when markets make certain moves to certain levels or stocks and they just can't get beyond. Yeah, sometimes it's just a valuation, ceiling, but many times it's just like, hey, we can't sit up here and we just can't move this up anymore. A lot of times you'll look and see stocks that have been just butchered and beaten down where managers bought too much. And so they're looking to actually buy. Netflix has been working its way lower and it split 10 for 1. Okay. So it's working its way lower from like 134 to 100. So it's down 34%. You might be surprised that some managers actually might have bought it at 115. So it drops lower. What do? They will dollar cost average out of reluctance, not because of value. They don't want to buy it. They're worried. They're going to have to buy it because they tell their clients, listen, we want to maintain a certain weighting of Netflix at 3 to 4% of the whole portfolio. They may have bought here and put in 3%. Now it's down to 2%. They'll look at buying down here, and the time. This is the thing you're missing. The time that they do it, they don't buy on the way down. Like, that's the biggest mistake a lot of you make. There's no money managers. They don't buy on the way down. You do. They're not buying on the way down. They're waiting for consolidation. So if they're ever going to buy Netflix, they're going to wait for it to go into a sideways channel first. And here's the thing. Most of you go, I don't like sideways channel. I live and die by them because I'm trading with an algo and I'm trading with big money. If they're buying, they're defending me. If they're shorting because they have to sell because it's like a rebalancing, they're defending my short position. That's the whole point. So to me, the best place to ever buy, ask Gianni, is on a breakout. It's on a consolidation channel. And if you know the motivations behind it, it puts you in a much better place to time the buy than it would otherwise if you didn't know it. There's many reasons why. I told you. There's reasons because it's just, like I said, I have the reasons posted here. I brought up things like, lack of a catalyst. I can't drive it higher. Indecision. A pause to digest. Valuation. But to me, rebalancing is my favorite one because I go track the money flow and I'm looking for volume to defend me. That's what I often do. So what I often tell clients is in the mentorships is this: go put up volume average and or go put up a volume profile. Go put up a volume profile because you can see the liquidity nodes where the institutions will play. Let's play. Tells you like right now, you're not going to get a lot of institutions going to buy it here. Look at the liquidity. It's terrible. Look. So whoever's trading it here is trading what's called tiptoe. There's no institutional participation here, which is why it won't move up. There's no catalyst to move it up, and there's no liquidity to move it up because there's none. Look, and liquidity here is kind of like dying on the vine too. This is a bad place to buy. If you want to know a place to buy, I'll show you. Buy where there's liquidity, like right over here. Look at this liquidity node right here. There you go, 95 bucks. Step in and buy when it drops $8. That's where the institutions are playing. Look right there. They're playing right there if they're going to buy that for rebalancing and upward. That's a good place to play. Not here. So be aware of these rebalancing areas, zones, channels, because it's the best place to get in to be defended on a buy side or a short side. You take this back up to 125, I'm going to short the crap out of this. Why? Because look at all that overhead supply. They're going to knock it back down and maybe take it to like 115 where it thins out. That's why. So this is what I mean to bring to you about rebalancing. The other part of today's discussion Another motivation is just the dearth of order flow. Oh no, there's that fancy word that Bierman's using. Every time he uses the word dearth, I can't stand that guy. Okay, stop. Shh. The word dearth is a fancy word for scarcity, lack of. Dearth means scarcity, people. Go get a dictionary. That's what it means. So lack of order flow will often leave it in a lurch. And people like, give me an example. I'd be happy to give you an example. Let me show you exactly what I'm talking about. So right now, I'm looking at Nike. Good old Nike. Give me Nike. Give me some Nike. Okay, stock simply cannot catch a bid. Now, I wouldn't buy this stock with your money. I've been bearish on Nike since 185. How's that working out for me? Really well. I will not buy this. No way, no how. Didn't bite on the crap sandwich when they rallied it to 75. Look, sell it. You're in a downward ascending channel, downward descending channel. That's a Genesis cog short, people. Right there is the best short. You short it there, or you short it there. Either or it works. Here's my point. I'm not in this trade. I don't want to short it because it's too oversold, but I ain't going to buy it either. But here's the point about quote unquote the channel. So I'll draw the channel for you. Let me bring this up, adjust my screen for you. What do you mean it's in a channel? Here's what I mean. Stock is in a channel. And I'll even activate it and move it up to grab the higher part of this and show you. This is called a channel. It's locked in a vol box. It's not breaking out to the upside, and it's not imploding to the downside. It's got really good support at 60. At 60, me buy. Everybody wants to buy at 60 because it's Nike. But it's $2.70 above that buy level, but it's in a box. Here is my point. In order for it to get out of this channel, or why, ask yourself, why is it in this channel? That's the key. Why is it stuck in the channel? Look at the volume. That's the volume average. That's a 50-day volume average, 50-day. Okay. Notice how the volume since 11/14 last week continues to fall off. One reason is seasonality. Another reason is because there's no catalyst, clearly. But when there's no or lack of order flow, algorithms are not interested. Algorithms are like flies to a turd. Algorithms are like literally like a crack addict to a needle. Seriously. This is how it works. As soon as an algo spots some pickup in order flow, it as a sniffer, it actually it can pick it up in its scanner, and it'll watch the action, it'll watch the slope of the indicators, but it's always tracking volume. And if the volume looks like this, it doesn't get the interest of an algo. Now, that's not to say an algo is not trading. There are algos trading this. Algos are trading this, but they're what's called trading lightly. They're not trading heavy. Trading heavy is when it goes parabolic and it's like, that's at $11. Like algos were crushing it last week on Ross stores. Algos were running that, gunning it, and squeezing it, and just making you crap in your pants on the short side. That was algos, all algos. This is, the algos are like, the algos are in it, but they're not in it. They're like standing on the sideline going, yeah, this is not the stock. Look at it, it's 8 cents. There's no interest in this. So what should you do? Nothing. Don't trade it. Don't trade something where the order flow falls off. Why would you do that? You don't think you could fall through here? Could. Lack of buyers is enough to drive it down. People are like, you need a preponderance of sellers. No, you don't. Lack of buyers and the stock will go to zero. Did you ever think about this, TheoTrade members? Because I posed this question to my classes at Loyola, to my students. If there were no buyers, would there be any capital market? No, there'd be none. You need buyers for a market to work, which is why I love Garrett's expression. I'm the notorious short seller. I love short selling. Why? Because when I run out of buyers, I get rich. You need buyers to sustain markets. You don't need sellers to sustain markets. You don't. Without buyers, markets implode and they die. They go to zero. Think about it. So if there's no buyers here, it can just keep going down. You don't even need sellers. So be aware of volume. Volume and liquidity go hand in hand. When there's a lack of volume inside a channel, Stop forcing the trade. Stop. Don't force it. There's no reason to trade this at all today. None. Zero. None. There's no vol. No liquidity whatsoever. Look, it's just dead. And it's not just because it's Thanksgiving week. That's a lame excuse. It's always like this for stock. They've been going down for a while. Nobody wants to window dress this stock. They're worried about Christmas sales. The prices of these products are too high, and the consumer's in a bind. The consumers suck and win right now. That's why the stock's down. Okay, end of story. So you're looking at that. Then you go over here and you realize there's a lot of liquidity right there. But right above it, the liquidity thins out, which means you'll get buyers to defend at 60. But above that 64, it just doesn't have that much appeal. And then above here at 68, there's probably a layer of sellers. So a lot of people are looking at this going, there's not a lot of volume here, and there's not a lot of liquidity here, and the liquidity thins out. Automatically, it sends a message to the algorithm. Don't trade me or trade me lightly. So be aware of this. Nike's just one example. I'll give you a couple of others while I'm here. And I don't mean just on the buy side. I don't mean I'm talking about when it's overbought too. And when you want to short it, it's like, don't do it. I wouldn't short this because it's too oversold. But at the same time, there's no interest in buying here because I don't have any volume. Let me bring another one to you. A lot of people are like, there's no way in the world I'm going to trade Lulu. Take a look at Lulu. Is it cheap? It's one of the cheapest stocks in the market. This is the lowest valuation Lulu's traded in ever, in the entire history of its existence. It's never traded below a multiple ever of 30 until this year, ever. I don't want it. I own it. I own it at 165. I don't care. I own about 25, 50 shares of it. But I know one thing. It ain't going to break out, so I don't have to force the trade. But I'm buying it with the expectation or hope that it will break out. What's my problem? Here's my problem. Go look at the liquidity. Go look at it. Look at it yourself. There's nothing more you need to say other than this. Look, if I can just grab it. Look, there's no liquidity. So could it go down? Yep. Could it go up? Not likely. I'm waiting until the quarter ends at the bottom of the support level where there's huge liquidity down here. When do I think it's going to break out? Not now. Not tomorrow. Not next month. Nope. I don't care. I'm not a money manager who has to put up numbers. I'm not the one who was feet to the fire. You are. I don't have to worry about it. You money managers, come on down. I'm sitting here going, listen, ain't going to move. Why? Scarcity of order flow. It's just a challenge. This isn't about fundamentals. It's about optics. It's about order flow. There's none. So it ain't going to go up. I know that. You don't got to tell me. If it gets to 180, okay, and doesn't get above there, I'll just sell it and take my money and make 20 bucks on it. That's it. But if it gets above 80, okay, watch the order flow. Because if the order flow automatically picks up right there, that stock could run to 200 by the time you get off the toilet. Oh my God, it's up 20. Because the algos will sniff it, order flow, vertical MACD, it's gone. Why is it going up? Nobody cares. If the algos get it, they're going to squeeze you and wreck your account. You can't short it because it's too oversold. You can't short it because it's too cheap. But if you want to buy it here, it's not going to go anywhere. I know that. Don't anybody send me a letter. I got like 2 emails from COG members. Why do we own this? We don't own it for today. We own it for next year. Because by next year comes around and starts to get some order flow to it, get some liquidity to it, could make a comeback. Michael Burry owns it. It's okay. I didn't buy it because of him. I bought it before him. I bought it because the stock is dirt cheap. They basically blessed their guidance for their earnings and sales, so there's no uncertainty there. And I figured to myself, they're probably a buyout candidate. They might just get merged with somebody. I don't know. Or they might get an upgrade coming out of nowhere. But this stock is not going to move up. But if it goes above 300, we all know one thing. If this stock gets above 300, it'll be 100 upgrades. Goldman Sachs will upgrade at 300. They will not upgrade it now. You know how Goldman is. You know how Morgan is. We hate it. It's up 100. Upgrade. That's how they operate. They're Monday morning quarterbacks. That's why they're useless to me. You got to get in before. I'm in it before. But here's the thing. Think about what I'm doing. I know it's not going up. I'm not sitting here going, go up, go up. I'm sitting here going, it's not going to go up today. I don't even look at it day to day. I actually don't even look at it. Literally. I'm like, 50 shares. I don't even care. I'm telling you, it's not going to move until the year is out. All I have to do is look at the order flow. If the order flow breaks higher, that's going to move. And it's going to move fast and furious. That's all I know. So a lot of times when you see stocks going up or going down, okay, think about what I'm teaching you here. Don't over rationalize this. Just sit there and go, hey, the stock's coming down. Gianni doesn't freak out over Apple. You see Gianni go sell. Gianni looks at it and goes, hey, they're rebalancing. Yeah, they're rebalancing. No big deal. in the case of Lulu, in the case of Nike, it's about we don't want to own this right now. Don't worry. It's not even about indecision. They just don't want to own it for optics. So if there's no order flow, don't force the trade. Don't put on a trade. You don't need to. I'm not forcing an options trade because I want time removed from the equation. Come back tomorrow because we're going to talk about fear and disappointment, two big emotions where stocks can stay in a channel, not for a day, not for a week, for months to years. I can't get out of that channel. You're stuck it feels like you're in purgatory forever because people are just frightened of that stock. They're frightened. They got so badly burned. So just channels. So you're like, I'm going to force a trade because it's down. Waste of your money, waste of your time. It's in purgatory. People are just terrified. We'll talk about this tomorrow. In the meantime, I'm going to let Brandon take over. I actually have to run. It's hard. I'm hard pressed to tell you this. I got a class to teach at Loyola today. So I got to run downtown. Don't got to teach Wednesday or Friday, but I got to teach today. So with that note, on that note, we'll come back and finish Killing Time tomorrow. In the meantime, I'm going to leave this to Brandon Chapman. Brandon, what a waste of a day. All the stocks that ran up on Friday, every one of the stocks that ran up on Friday that I had 7 stocks that all was up more than $3. They all came back down today and gave back half. It was like risk off day on Friday. Okay, risk on day today. Brandon, it's just like money's moving back and forth. So I look at today, I'm like, what a waste of time.
Yeah.
What do you think?
Well, that's the thing is, I mean, is this a bull trap or is this the next bullish move, right? I mean, and so Blake and I are going to talk about that today and what are the opportunities to go long and what are the opportunities to reload? And we're going to look at the console today and see, okay, where the big prints kind of leverage what happened on Friday as well. So yeah, I'm kind of with you. I think this is more of a reload to the downside scenario, but is there any opportunities to squeeze any more out of this trend, out of this move today?
You're asking the wrong guy because you and Blake track, the SPY. I don't. All I know is I started doubling down on my shorts this morning and they just completely collapsed. So I'm going to stick with the short trade. That's all I'm going to tell you.
Yeah, no, I think you have to look for an opportunity to reload to the downside. And so I was hoping to get on my XLE today. It's reversed. USO still hanging in there on the bearish side, but more big prints today, bearishly in XLE. So we'll see.
All right, man. Hey,
have a good one.
You and Blake have a great day. All right.
Yeah, you too.
All right.
All right, let's get going here. Let me share my desktop. We'll start to fire away for Ghost Hour today. Brandon and